This is the weekly outlook here at xam.com. Thanks for joining us. I'm Christina Marujos. With me today is senior investment analyst Marios Hadjikyriacos. We'll be having a look at the main events of the upcoming week. However, Marios, what a week this has been, with the Omicron variant causing mayhem in markets and Chair Powell dropping a bombshell that the Fed will consider accelerating the pace at which it withdraws liquidity from markets. Therefore, the U.S. inflation report on Wednesday is crucial, as it could decide whether the Fed will speed up tapering at the December meeting. What are we likely to see in the numbers, and what could that mean for the dollar?
Hello, Christina. It's definitely going to be an exciting week for the dollar. Now, we learned a lot from Powell this week. He essentially told us that the Fed is really starting to be stressed out about inflation. He highlighted repeatedly that inflation risks have intensified. He downplayed the Omicron variant. And overall, you're getting the sense that the Fed is inching to step on the policy brakes in a sense. Why? Because inflation, of course, is high and rising. The jobs market is doing very well. Wages are firing up. Consumption is booming. And overall, it looks like the U.S. economy might overheat if they don't, accelerate their tightening plans. So they're thinking about ending their asset purchases a few months earlier, and that would essentially open the door for raising interest rates a few months sooner. Now, the question is, will they announce this at the next meeting in mid-December? And if so, how much faster will they dial back their asset purchases? And of course, the upcoming data are going to be absolutely crucial in answering this question. Now, we don't have official forecasts yet, but my own calculations suggest that we're likely to see the CPI rate heading towards 7% in yearly terms. Now, that could seal the deal, I believe, for an acceleration of tapering, because we've seen it's not just Powell, right? We've seen several Fed members, or more than half of the Fed lately, Vice Chairman Clarida, a couple of board governors, several regional presidents. There's this clear movement inside the Fed that they want to accelerate tapering. So if inflation fires up any further, that will give them the perfect excuse to do that. And of course, that argues for more strength in the dollar. The markets right now are pricing in 2.5 rate hikes by the Fed next year. If we see tapering being accelerated, that would push market pricing towards 3 rate increases. So that argues for the dollar to resume its uptrend.
Now let's cross into the central bank front. We have 2 central bank meetings this week, one of which, of course, is the Reserve Bank of Australia, which meets on Tuesday. What are policymakers likely to signal? And can the RBA give the Aussie much needed support?
I doubt that, actually. So we don't expect any policy changes. The reaction in the Aussie is going to depend on any signals about future moves. Now, there has been both good and bad news since the Reserve Bank last met. Economic growth didn't get hit as much as we feared in the third quarter. Consumption was relatively strong. But on the other hand, the labor market got hit by lightning in October. It was a very disappointing jobs report, and I think that's going to keep the Reserve Bank a little bit cautious. And of course, we have the slowdown in China, right, which matters a lot for Australia because they have a very close trading relationship. Now, here's the bottom line. The markets are still pricing in 3 rate increases by the Reserve Bank of Australia for next year. I think that's overly optimistic. I doubt we're going to see more than 1. Therefore, I think there's a lot of scope for market pricing to get deflated, in a sense, to come down. And if so, that would argue that could deal another blow to the Aussie that has already taken a beating this month.
On the other hand, Marios, we have the Bank of Canada meeting on Wednesday, where in contrast to Australia, it looks like smooth sailing for the Canadian economy right now. At its last policy meeting, the Bank of Canada shocked markets with its hawkish turn. Therefore, what are we likely to see at this meeting, and what is the outlook for the Loonie?
Well, the outlook for the Loonie is pretty positive. So you have to be feeling good if you're the Bank of Canada because you have an amazing economy right now. You have hot inflation. The jobs market has virtually recovered. Businesses are optimistic. Housing market is on fire. The only dark spot, in a sense, is the recent plunge in oil prices. But I don't think that's going to be very worrisome for the central bank because that follows a very strong rally, right? So the overall outlook for the Loonie, I believe, is positive. A lot is going to depend on how oil prices trade from here. But as far as the Bank of Canada goes, I don't think it's going to be a huge variable moving forward in the following sense. The markets are pricing in 4 to 5 rate increases by the Bank of Canada next year. I think that's fair considering how strong the economy is. That's more or less what the Bank of Canada might actually deliver. So, overall, the outlook is positive, but I wouldn't expect any huge gains on the Bank of Canada decision either.
Marios, it was great having you with me today. This was the Weekly Outlook here at XM.com.